Hi, I'm Shiloh Bates, and welcome to the CLO Investor podcast. CLO stands for Collateralized Loan Obligations, which are securities backed by pools of leveraged loans. In this podcast, we discuss current news in the CLO industry, and I get to interview key market players. Today, I'm speaking with Drew Sweeney, co-head of Global Credit at TCW. It's Drew's second time on the podcast. We discuss loans to software businesses at a time when AI displacement risk is elevated. Software loans, in my experience, usually begin their lives at a 40% loan to value, so there's significant equity cushion to protect the lenders in a downside case. The question now is if declining software valuations and cash flows will be severe enough to impair first lien loans. Some housekeeping items. I'm always looking for interesting guests to have on the podcast. Email us at info@flatrockglobal.com if you'd like to come on. And thanks for all the likes on our CLO 101 video on YouTube. If you're enjoying the podcast, please remember to share, like, and follow. And now, my conversation with Drew Sweeney. Drew, thanks again for coming on the podcast.
Thank you for having me.
So why don't you tell us a little bit about TCW and your role there?
TCW is headquartered in Los Angeles. We are an asset manager with about $205 billion of AUM, and then we are fixed income focused. Most of that AUM will be in fixed income or some form of alternatives. On my role, I'm the co-head of corporate credit. We focus on managing, of course, CLO portfolios, bank loan portfolios. We have $8 billion of loans. We have $3 billion of high yields, $11 billion of leverage finance, and then over $40 billion if you include investment grade of credit. And we're responsible for making sure that that is allocated properly across the entire platform.
How many CLOs do you guys manage?
We have 15 CLOs today, and we have 2 warehouses open.
The topic for today's podcast is AI displacement of software-related business, which is pretty important for CLOs. Just to start off, what's the underlying, when you look through a CLO and you find a portfolio of 200 plus loans, what percentage of the loans are going to be in software?
We look at the S&P Morningstar LCD index, however you want to reference it. That index that we kind of comp against shows about 13% of loans in software. There's also another category called IT services, and that IT services has web hosting, internet companies, things that are really pretty adjacent to software, if not software itself. Generally speaking, I think people circle the BSL market around 16.5%.
That's the index, but in CLOs, is it a smaller percentage?
It ranges from manager to manager. There are certainly some managers that are underweight. We heard of some managers starting the year selling some software and maybe kicked off some of the technical of having that segment better for sale. And then the issue is, it's not just the 16.5%, because it's kind of IT services and software combined. But then within healthcare, there are some borrowers, and the reason it's categorized as healthcare or healthcare tech is that some borrowers have largely been driven by what happens on reimbursements and healthcare and hospitals for the last 10 years. And those borrowers are really software borrowers within a single vertical. That isn't always picked up. And then there's also the same thing could be true in fintech, and the same thing can be true in some auto related businesses. So when you start to sort through different segments, there's more software than you think.
So 16.5 for the index. My understanding, though, is when you look through CLOs, that it's actually going to be less than that. And the reason is just that the CLOs are working around a diversity test, and it's going to penalize. I don't see 16% software in any normal.
You don't. And there's a reason You also have, a lot of times a cap of how much you can have for an industry. So optically, CLOs show up lower than that. What I'm highlighting is generally, even if a manager's completely matched with the index and is not above 12.5% in software, you might find other software in their portfolio in these other segments.
Well, that's a story that I've seen in the press. Which industry you're in is the CLO manager gets to decide. And often there's like, a strong case for to be in software or to be in healthcare. And, the manager makes the call, but there's nothing like untoward going on there. It's just differences of how they would kind of rate or evaluate a business model. Is that right?
It is right. There are healthcare tech companies that for the better part of 7 years, we've had our healthcare analysts looking at because the drivers of the business were less to do with software, less to do with software competition, more to do with the healthcare end market. The same thing's true in autos. We've had auto companies that are really focused on dealerships and their software businesses, but it's really about the health of the dealership, or at least it always was.
So I know there's going to be a lot of different business models in software, but maybe you could just talk through the general profile of a borrower, like how big is it in terms of revenue? Is it a couple guys in a garage with a PowerPoint deck and a dream, or like what's the profile of these businesses?
The general profile is for level setting. If we do the weighted average EBITDA of our portfolios, the weighted average EBITDA of our portfolios is over 600 million. And that's just for all of our companies. In general, I would say software are the larger businesses in the portfolio. If you look at the L100, the Morningstar S&P L100, 28% of the L100 is in software and IT services. They tend to be bigger companies in our universe. They typically been part of an LBO. They've been LBO'd at a very high enterprise multiple. They historically traded, I'd say on the low side, 12 times and, on the high side into the 20s, but typically around 15 plus times. And then their margins are 40% EBITDA margins. Most of our borrowers have over 100% net retention rates. They have high levels of recurring revenue, and they're generally 6 times levered plus, which is a low LTV if you believe the 15 times purchase price multiple.
So then, when a software opportunity is proposed to you from a bank, what are some of the key checklist items for you that make a credit worthy of your CLO capital or not?
We look at the contracts, and most of these have somewhere between 2, 3, 4, 5 year contracts for these businesses. You look at concentration of contracts, but then really when it comes to software type, the way we've broken it up, and this is part of the AI impact, is we've gone back through all of our software. I think if you looked at it a year ago, the question would always be, what's their market share? Do they have a reason to exist? How do they compete? How do they sell their product? Is it ERP? We've always had a positive view to enterprise software, things that are really hard to strip out of a business. Then the market became very concerned about AI's impact on software, really starting into January. We sort of took our portfolio and remapped it and said, what are the characteristics that have lower risk to an AI impact? Are they infrastructure based versus application based? Is it vertical within one industry? Are they dominant? Easy one to think about for that is, or is it horizontally across a myriad of industries? But in our business, Bloomberg, everyone in financial services uses Bloomberg. And so do you have this vertical incumbency? We look at the customer base. We prefer enterprises, large enterprises to small and medium businesses. Frankly, size of these companies matters. If you're big and you're really built into an industry, healthcare, autos, whatever the industry in market is, financials. That's important. But we want enterprise software. Those are the things we look at. And then the more customized it is, the harder it is to displace it. And the last thing I'll say is another item on the checklist is just data. Do you have proprietary data as part of your moat? Right now, the value of AI for a lot of daily use is essentially steals data. I think that will change over time. And certainly there are moats a lot of companies have put in place.
How long has AI displacement risk been a hot topic for your firm and investment committees?
It started at some point last year in more service related businesses, specifically inbound, outbound call center businesses. That was the first discussion broadly in the market of what's going to get impacted. Business development software last year started becoming a topic because of coding, replacement of coders, the need for some of this business development software. What we can do now on the desk through our existing platforms is different than what we could do 3 years ago. I think those two things came up last year. Then there have been some questions around the impact within education and some of these other testing related to education. So we first started having the conversation last year on some of these subjects, but really the rate of change in the last 2 months has just been dramatic. So we've had to re-underwrite the entire tech space and the services space in the last 2 months because it's dramatically changed.
In terms of the financial performance of these borrowers, have you seen any of the potential increased risks here? Have they shown up in revenue and EBITDA, or is it that this is a risk that's still on the come?
Yeah, it's definitely on the come. It's an existential risk. If I think about it, there's no impact from AI in our businesses today. We're all trying to use it, we're all trying to harness it, but we don't see any impact to revenue or EBITDA from at least the borrowers that we're involved with. Every CEO that talks or CFO that talks on earnings calls is really focused on how they plan to harness AI, how they're embedding it in their existing processes, how they can take costs out of the business as a result. It's really not something this is now going to be an on the shelf replacement for a product that exists. Certainly not today. It's kind of interesting that we're in a weird period of time too, because all of this concern really popped up at a bad time for loans in the sense that we don't really get any earnings announcements until April and May for a lot of these borrowers, overwhelmingly most of these borrowers. You're kind of in this quiet period where you have to think through, is this really a concern or not a concern, and how are people going to deal with it? But we had 14 borrowers report recently, 11 of them in technology, in software. 11 of them were very strong. Revenue growth somewhere between 1 and 28% for all these borrowers. EBITDA growth somewhere between 2 and 38% for all those borrowers. The three borrowers that didn't produce good numbers that had nothing to do with AI. And this is what you're going to have. You've got great visibility for the next 12 to 24 months. One day, will there be an issue? We don't know if there's going to be an issue in 3 or 5 years. And we don't know if it's something that just takes away pricing power because it makes everybody more competitive. And so you have less pricing power. Maybe you have fewer seats at all these companies. Revenue model changes a little bit, but then are they also getting fewer seats and preserving margin? are taking out costs otherwise. They're hiring fewer developers, doing other things like that. So I think there's uncertainty when you start going 3, 5, 7 years out of what the world will be like. But in the next 2 years, I'm guessing that most of these businesses perform really well. If you look at the JP Morgan index and you say the average cost of a price of a software buyer is 89 cents on the dollar or below 90, and you start looking for swaps at similar prices in other industries, you can swap into a chemicals borrower that had EBITDA down 55% year over year for the same price as selling a software business that had a 30% plus growth in EBITDA in the last quarter. I think it's hard for our business in general, as software is very difficult to understand. When we're talking about software risk earlier, we didn't talk about AI risk to other business models, but there have been a few days where insurance, not a few days, but insurance trades a little heavier than it did before because people are concerned that insurance brokers, most of insurance for loans or insurance brokers, will be negatively impacted by AI. And that you'll find as an end buyer of insurance, AI will allow you to buy this easier without the use of a broker. But it got slammed really quickly when there's some model, I believe in Spain, that talked about this is how they're going to distribute their insurance product is through an AI tool. I think our industry understands that model much better than they understand in software businesses. And as a result, bids came in very quickly. So insurance traded down 2, 3, 4 points, and then people started bidding it back up. With software, we're really, as an industry, loans in general, the loan market has historically been really bad about valuing enterprise values. We may understand how to structure a deal to get our money back, but we don't value the equity very well. And so this is sort of at the heart of what we do poorly.
So you mentioned these businesses are levered 6 times EBITDA or cash flow. And I imagine the rates on these loans is like, I don't know, SOFR plus 3%.
They've all tightened in the last 24 months, 325, 300, somewhere in 275, 250. You've got this range for, let's say, a B2 software company that's probably 250 to 350.
So if you're levered 6 times and that's your interest expense and you don't have a lot of CapEx or working capital, I mean, can I assume from that that these businesses generate a fair amount of free cash flow every year?
Even with their leverage, many still produce really good free cash flow. Their margin profile allowed them to take on more leverage and really still produce some amount of free cash flow vis-a-vis other businesses that have 20% EBITDA margins. That's where I find it interesting because you've got a lot of companies that are coming up on maturities and sponsors that want to,
They want to extend the life.
and the option of their equity. Structure can allow them to refinance things. Our market, another general complaint I have is if you're worried about a business model, if you're saying there could be an issue, a melting ice cube over the next 5 to 7 years, if you're worried about those things, generally what happens is the street comes out, they market a deal, they ask for feedback, and I almost always give the same feedback. Put amortization on the deal, make it 5, 7.5, 10, 12, and then let's try to get in the next 5 years, basically amort that cuts debt in half. The response is always generally of the broader market, add another 25, 50 bips to spread, and that will cure the problem. To me, that's always been a weird response that the additional spread doesn't actually fix anything. If sponsors don't want to put in a turn or 2 turns of equity to reduce debt by 1 or 2 turns, which I think if you have a deal trading at 85 cents on the dollar and you want to refinance it regular way, you would need to contribute a decent equity check. The other option is add real hard amortization to it and have this loan pay down over 5 years. It's nominally going to affect the sponsor IRR. They'll have a lot less debt at the terminal value. They should be happy with that.
So the typical amortization or required principal in a broadly syndicated loan is like 1% per year and then a bullet in year six. And you're saying, yeah, let's do 5% a year or something like that.
I think going back to the days of when I was in Lev Fin at a bank called First Union in North Carolina, we would do more along the lines of 5 for the first year, 7.5, 7.5, 10%. It would step up 12%. You would get significant pay down by year 5.
So in the existing portfolio, we're not seeing an effect on revenue and cash flow yet. What's been the price action on these loans? And by the way, we're recording this on the 11th of March.
I think at the end of January, we first started seeing a real sell off in software and related services, things that aren't software too. There are AI risk exposures to legal businesses in our market, to tax businesses in our market, to accounting deals, consulting, government services. All these other service businesses are also being impacted. CROs, there's concerns, not to the same degree, but there are some concerns about contract research organizations that focus on pharma. There are concerns there too. The 16.5% of software is one item. You really quickly get up to 25, 30% if you're saying what can be influenced by AI. The price action that took place is the insurance companies were down as much as 3 to 5 points. They've had some stability and rebound since then. The average price in the JP index today is below 90 for all the software borrowers. Ones with lower leverage, that's been a big item. Lower leverage deals generally are probably somewhere between low and mid 90s. Then, if you look at short maturities, a lot of those have been hit. They're trading in the low 80s. The market's concern is, can they refinance this deal? Not all of those. I mean, one's in the low 90s, but realistically, I think there are deals to be had to refinance these. Sponsors and banks and investors have to look at these deals differently than they have before.
Is your view that the risk here is going to be on the revenue side? But in the interim, would you expect many of these businesses to be able to grow their margins through employing the same AI tools that could potentially displace them as well?
I think the first risk I see is enterprise multiple risk. If this company was bought at 15 times, it's probably going to be worth 12 times today. Theoretically, that really should not impact our borrowers at all if you're 6, 7 times levered. There's plenty of cushion. The issue that's unique to the loan market is that we have LMEs.
LMEs are the out of court restructurings.
When you have loan prices below 90 persistently, you have advisors that basically call, and all they do is just call. They hope to generate revenue by getting a borrower or a group of investors or a large investor to think that the best next step is an LME.
An LME, so a liability management exercise. So that would imply a haircut of principal for the lenders in exchange for some tightening of terms in the loan doc, or
Yeah, in exchange for something. And there are two parts to that. LMEs in the BSL market, the broadly syndicated loan market, are not necessarily pro rata. I think our world would be way better off if all LMEs were pro rata and all debt investors were advantaged and disadvantaged to the same amount. Unfortunately, that's not the way this world works. And so some will do better than others in this process. It's like a prisoner's dilemma. That's how they motivate some investors to step forward from the advisor side and from the sponsor and company side in order to disadvantage other investors to either provide liquidity or to cut debt. Because historically, you only have LMEs where a company needs liquidity. These companies have no liquidity needs. So this will be different.
I know you're a broadly syndicated loan manager, Drew, but do you have a sense for how software loans and CLOs are different from the software loans you might find in like a BDC or another vehicle that's maybe taking more risk on the assets?
I don't at the asset level. And so what I do know is this. In the loan market, if you say software IT services is 16.5%, that's probably 23% in private credit. And then that's probably 31% at the larger private credit shops, direct lending businesses. It all scales higher. And my guess is, in general, there's going to be more leverage on those private deals that are owned in BDCs. And my guess is that the EBITDA is probably 10 to 20% on average the size of our borrowers. If I just use those assumptions, the BSL market should do far better in terms of the enterprise existence. They should do far better. The thing that is not straightforward about it is LMEs, poor credit documents, sponsors willing to try to keep their option value alive, and haircut debt. And so when you add those three things up, it will be harder to tell. But I would think larger software businesses that are more ingrained in big companies would do better in this period of time.
So, from my perspective in the BDCs and private credit, yes, the software loans are to much smaller firms. I think they're done at higher leverage. They tend to be more chunky exposures. In the CLO, you have this hyper diversified portfolio. And in a BDC, you might have, a 5% loan that the manager was convicted on, or maybe that was just a size dictated by the borrowing. But a lot of those loans are at SOFR plus 5.5 to 7. So the risk profile is very different. Plus, in BDCs, you're going to find some second lien and some sub debt and, other funky stuff that probably wouldn't have a natural home in a CLO. The dilemma, though, is that I feel better about the assets, but then, the BDC doesn't have a CLO leverage.
That's true. If you've looked at other periods of time where there's stress, I view this as an enterprise multiple exercise. I don't think software will cease to exist for a few reasons. And I think the tail is going to be way longer than you expect because if you think about AI today, if I want to pull down a tremendous amount of information on any subject, I want to sort out colleges that are going to have great journalism programs that are this size school in the Midwest. AI can do a beautiful job bringing me all this information. But if I'm doing that for 50 students, then I become limited not by the information AI gives me, but I'm limited by my ability to work through the information that it's giving me. I'm the limit. And at every single one of our companies, every company in America, the limit is the manager who is trying to process that information. AI businesses could move far faster than institutions' ability to change. We just used Aladdin, accounting and software to implement at TCW, and it took not only a Herculean effort by the people who actually do all the work, but also by all the PMs, all the traders, all the groups to sort of run dual systems for a period of time and to learn how to use it as a trading function, learn how to use it for your attribution and all this other stuff. There's no way, because this information is incredibly important, there's no way that in the next 3 to 5 years, we're turning that over to an AI homegrown solution. It's too valuable, it's too important. And then even if you start to get comfortable on that idea, then you have to get the organization comfortable with the idea that now you're going to have people do two jobs for some period of time as they try to integrate in a new system again in less than 5 years after they did it once. That will allow very long tails, even in a scenario where AI can do more than you think.
When does it realistically clear up, if it does in fact clear up? In your view, is it that 6 months from now, if businesses haven't seen any effect in their reported financials, that loans will migrate back towards par? It's kind of hard to disprove the negative. How do you think this year might kind of shake out on this front?
It feels to me they're generally oversold, and they're oversold because we were in a vacuum of information. Some of these software businesses have pre-reported to try to get ahead of it. We had one borrower that they had 2 pages in their deck maybe a year or 2 ago on AI, and this last quarter, they had 20 some pages in their earnings deck on AI and how they're using AI and how it's helping them. That is something that when we get through, when 30% of the market has reported from any industry that could be impacted to software specific businesses, when they're all said and done and these CEOs address the concern, I think that helps give investors confidence. It's one thing to feel confident about, oh, 3 or 4 names, but when 30 or 40 or 50 names report and they provide better information than the borrowers had before, that should help the price. It's just incongruent to have both software trading below 90 and reporting great numbers and 80% of loans trading above 98. Something has to give. Either broader market needs to weaken or software is going to find a little bit of a bounce. And when I say a bounce, it doesn't mean it all goes to par, but a loan at 92 might be at 95, 97, and a loan at 82 might be at 88 because a lot of these loans at 82, they traded down. We had one loan trade down from 80 to 70 on $1.5 million of loan trades. That's not significant, but it took probably 10 to 12 million of buys to get it back to 80. The dealers are ripping these loans down quickly because it helps them generate volumes, but it does leave the ability for a lot of these loans to rip higher again.
Isn't another challenge from this kind of market overhang, though, that something that's weighed on CLO equity returns is that just not enough loans have been created. There's too much demand for loans and not enough supply from LBOs. 20%. I mean, that was one of the numbers you used. I mean, if those businesses don't come to market as new LBOs, I don't know, maybe private equity wouldn't be targeting those spaces now anyways. But if one of the results of this is new loan issuance is down, I mean, that's also like pretty negative, I think.
I think it's a great point. If you look at software over the last 5, 7, 10 years, it's grown as a percentage, and tech has grown as a percentage of the index by 5, 6, 7%. It's grown consistently over the last 5, 10 years. And it's just because that's where our world is. There are more and more businesses like this. Private equity still raised a ton of money. In my mind, it's very hard to deploy that money without either a give in what people are willing to sell businesses for or lower rates. So if we get to a period of lower rates, I think you'll start to see more LBOs in spaces that you haven't seen, building products and home builders and things like that. And we've seen larger and larger LBOs too. We do need supply. That is one of the issues we've had. But that's why we had 18 months repricings.
So then last year was a year of higher defaults. And then this year, is your expectation that the trend will continue plus some percentage of software names that are really affected and really displaced? How are you thinking about that?
So at the end of 2024, the default rate adjusted for these distressed exchanges, liability management exercises was about 4.7%. And then if you Fast forward to January, LTM, it was down to 4.3%. And it's largely, in my opinion, that those 2021 purchases by sponsors, a lot of the problems had been identified and had LMEs or defaults. So it felt to me like we were going to have a lower default rate. The actual Chapter 11s only represent 1.25% of that 4.3 or something. With software moving down, lower prices beget problems in the BSL market. They invite an LME potential, even if a company shouldn't be doing it or doesn't need to do it. The probability of it happening increases. So where I get a little concerned is that if you and I talked in February, and we did, I would have said, I think you could see lower defaults this year by year end in the broadly syndicated loan market. It's hard to tell with software. I mean, it's such a big space. If people start trying to through LMEs, we could see it stay at 4.5 kind of level for some time.
To put a positive note on it, some managers are stepping into these loans at discounts, and it's the first real opportunity in a while to buy a loan at something other than par. If somebody thinks these loans are attractive at 90 cents or 80 cents or whatever it is, and they can ride that back up, given the leverage in CLOs, I mean, that'll be a home run for the equity.
That's right. There are going to be winners and losers, and a lot more winners than losers. And I'm only focused on my market. This is the only market I know. But I think there will be way more winners than losers. We've been very active in trading, repositioning our portfolio. We picked up 8 names in the last month and a half that we didn't own. And the reason we didn't own them is they're kind of this B1, B2 profile that had priced at 250, just way too tight. And it wasn't that we had any crystal ball and thought, let's not pick up the software. It was just the relative value was terrible. And those names traded into the mid to low 90s. And these are 4 times levered businesses that are really good businesses. And you're sitting there, it's hard not to want to own those. We'll see.
One of the things that is a little bit surprising to me in terms of how this risk is reported through the press is that the press reports it as credit risk is up for these software loans. And that's true. But what's not reported is that in every one of these private credit loans, or most of them, there's some private equity firm that put up probably 60% plus of the initial capital to finance the business. So, a much more interesting headline is, well, as you know, when the loans default, usually the private equity firm's getting a goose egg. A much more interesting story, salacious story, is increased defaults are coming. That's a debate. But enterprise values, the total values of firms and software have come in, and it's warranted, it seems. It's a real issue for private equity, and it's a maybe issue for its lenders.
I think that's 100% correct. And it's funny because this is what I was saying on these enterprise multiples. If something goes from 16 times to 10 times and the deal had 6 times leverage and ends up being 7 times leverage because revenues were impacted in some way or another, the bank loan's still getting out whole in that scenario. It's a disaster for the private equity firm. This is on the heels of private equity not returning capital for the last several years. This vintage is going to be pretty awful for investors in private equity because I've heard consistent complaints about the 2021 vintage. They haven't returned capital to their investors. So that's been an issue. And these LMEs are only a symptom. Yes, they impact us as a market and it's a negative impact, but it's not like that helps. It's usually providing liquidity for some period of time. And it doesn't mean that company ultimately doesn't default. And in a default, If we end up getting 20 cents of debt and 50 cents of equity, which we had earlier in the year for a deal, and we sell that equity, we still got a 70% recovery with the equity on that default. Our lives move on. That's fine for the CLO. But for the private equity company, that's a disaster. And now, if you combine that with their exposure on software, that's not going to help returns. To your point, that's just a more interesting story.
So, Drew, since we did our first podcast together, I've introduced a closing question that I always ask my guests, and it's describe a CLO in 30 seconds.
If you can imagine buying a rental house and you take a mortgage on that rental house and you have income coming in from the renter, as long as the income is greater than the cost of the mortgage, the payment you make on the mortgage, you're making money. Now imagine buying 250 rental houses and you're paying out your mortgage on 250 properties and you're getting rent on 250 properties. If all of that rent, all those renters pay their rent, then the return to you is going to be quite exceptional. If they start defaulting on their rent payments, then it's pretty negatively impacted. Instead of a rental, a CLO is just a corporate loan doing the same thing.
Great. Well, Drew, thanks for coming on the podcast. Good to see you.
You too. Thanks.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. This podcast is not directed at any investment or potential investors in any FlatRock Global fund. All statements of opinion or forward-looking statements herein are based on current market conditions and should not be construed as guaranteed as future events, and are subject to change at any time without notice. For definitions of words used in this podcast, please go to flatrockglobal.com/glossary. Risks. CLOs are subject to market fluctuations. Every investment has specific risks, which can significantly increase under unusual market conditions. The structure and guidelines of CLOs can vary deal to deal, so factors such as leverage, portfolio testing, callability, and subordination can all influence risks associated with a particular deal. Third-party risk is counterparties involved: the manager, trustees, custodians, lawyers, accountants, and rating agencies. There may be limited liquidity in the secondary market. CLOs have average lives that are typically shorter than the stated maturity. Tranches can be called early after the non-call period has lapsed. ETFs are subject to market risk, including the potential loss of principal, and may trade at premiums or discounts to NAV. General disclaimer section. FlatRock may invest in CLOs managed by podcast guests. However, the views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates. Any return projections discussed by podcast guests do not reflect FlatRock's views or expectations. This is not a recommendation for any action, and all listeners should consider these projections as hypothetical and subject to significant risks. References to interest rate moves are based on Bloomberg data. Any mentions of specific companies are for reference purposes only and are not meant to describe the investment merits of, or potential or actual portfolio changes related to securities of those companies, unless otherwise noted. All discussions are based on US markets and US monetary and fiscal policies. Market forecasts and projections are based on current market conditions and are subject to change without notice. Projections should not be considered a guarantee. The views and opinions expressed by the FlatRock Global speaker are those of the speaker as of the date of the broadcast, and do not necessarily represent the views of the firm as a whole. Any such views are subject to change at any time based upon market or other conditions, and FlatRock Global disclaims any responsibility to update such views. This material is not intended to be relied upon as a forecast, research, or investment advice. It is not a recommendation, offer, or solicitation to buy or sell any securities, or to adopt any investment strategy. Neither FlatRock Global nor the FlatRock Global speaker can be responsible for any direct or incidental loss incurred by applying any of the information offered. None of the information provided should be regarded as a suggestion to engage in or refrain from any investment-related course of action, as neither FlatRock Global nor its affiliates are undertaking to provide impartial investment advice, act as an impartial advisor, or give advice in a fiduciary capacity. Additional information about this podcast, along with an edited transcript, may be obtained by visiting flatrockglobal.com. This material is for general information purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any security. TCW, its officers, directors, employees, or clients may have positions in securities or investments mentioned in this publication, which positions may change at any time without notice. While the information and statistical data contained herein are based on sources believed to be reliable, we do not represent that it is accurate and should not be relied on as such, or be the basis for an investment decision. The information contained herein may include preliminary information and/or forward-looking statements. Due to numerous factors, actual events may differ substantially from those presented. TCW assumes no duty to update any forward-looking statements or opinions in this document. Any opinions expressed herein are current only as of the time made and are subject to change without notice. Past performance is no guarantee of future results. All investing involves risk, including the potential loss of principal. Market volatility may significantly impact the value of your investments. Recent tariff announcements may add to this volatility, creating additional economic uncertainty and potentially affecting the value of certain investments. Tariffs can impact various sectors differently, leading to changes in market dynamics and investment performance. Copyright 2026 TCW.